excited to have everybody here, discussing a really important topic. I know it's something that folks ask us about often, and if they don't ask us about it, they're probably asking somebody else about it. So navigating healthcare prior to age 65. So for folks that are on it waiting to hear about what to do when you're 65 or older, stay tuned. We have another webinar coming up next month to go over that. Rachel and Rob can answer questions on that if you wanted to reach out to them as well. But today we're focusing on what to do for those folks that are early retirees, or they have jobs that are not covered during traditional health plans, all of those sorts of things. We're excited to have our expert panel here to have that discussion. So a little bit about us. We see a lot of familiar faces on the registration list, so thanks again for joining us. Hopefully we won't disappoint. We are a financial asset manager here locally in Pennsylvania. We have an office here on the western side of the state in Pittsburgh, and we also have a centralized location in central PA as well. And really, we view ourselves as the go-to expert for anything financial. So we're not just a place to discuss investments with. We're a family feel, a boutique feel, and we really want to make sure that your whole financial picture is taken care of. So that's why, even though we are not experts in the healthcare field, we partner with experts like Rachel and Rob to help our clients out and make sure that everything is well taken care of. So we do a lot of things in-house, such as our asset management and financial planning. And when appropriate, we'll introduce other folks like Rachel and Rob here to make sure that everyone's really well taken care of. A little bit about our webinars. We do these, we try to do one every month or so from a wide range of topics. Like we said, we want to be that go-to person. So we'll give you some information here to maybe make yourself a little bit more of an expert on those topics. But if you want to go deeper, certainly reach out to us. Reach out to your advisor team if you're an existing client, and if you're not and want to learn a little bit more, this is a great way to learn about our firm and the things that we have that we can help other folks out with. So Emily and I are the Fort Pitt advisors here, kind of hosting our two experts. So a little bit about myself, Skylar Riddle. I'm a certified financial planner here and advisor with Fort Pitt Capital Group. So I spend most of my day speaking with existing clients and new prospective clients to make sure that we're helping them reach their short-term goals, their long-term goals. And a lot of that is on managing expenses and unknown costs. Healthcare is a big one. So that's why we're talking about that. Outside of work, I spend most of my time with my family, my wife and two kids and dog in the South Hills of Pittsburgh. So they keep me pretty busy. And with me is Emily Sippel here.
Hi, everyone. We're excited to be here. My name is Emily Sippel. I am a CFP and financial advisor here with Fort Pitt. I have worked in the financial industry for about 13 years at this point. Kind of echoing what Skylar said, I work with my clients to get them to build wealth up through their career and into retirement, and then through retirement. Outside of work for myself, I spend a lot of time with my family, doing yoga, water sports, anything activity-wise outdoors. And with us today, we have Rachael Kirschner and Rob Myers with the insurance services of Zelienople, and I'll turn it over to them to introduce themselves.
Hi, my name is Rachael Kirschner, and I do want to thank Fort Pitt Capital for giving myself and Rob the opportunity to talk to all of you today about a very important topic, and that's healthcare. I am the Vice President of Insurance Services of Zelienople. I've been an insurance broker here for the past 14 years. Basically what I do is assist my clients in navigating what's very confusing in the healthcare world, and it's constantly changing and impacted by so many things, and just assisting you and making you feel that we can come together and make the best decision for you as far as a plan and a selection. I love my job, I'm passionate about it, and yeah, that's pretty much me. I am married with a 4-year-old, and we spend a lot of time playing outside.
Hi, my name is Rob Myers. I've been working for Rachael for 12 years. Before I got to insurance services, I was a special ed teacher with the intermediate unit 4. I got furloughed because of the budget cuts, so all the younger teachers got laid off. But unfortunately, it led me to this place, which I love working for, and I want to work anywhere else. We're very up to date here at Insurance Services as far as getting information and communicating with our clients. But I also like that we have an old school feel in that we still go to our clients' homes if they don't feel like driving in or communicating over email. Some of them just prefer that. So that's what I love about this place. I'm married with a wife, and I have a 18-month-old baby girl, Piper, and I'm going to spend my free time down the Steeler game this Sunday, so hopefully I don't lose my patience too much.
Well, we're excited to have you both. Thank you.
Thank you for having us.
I'll just speak a little bit for our audience, how to interact with the webinar. If you are on a cell phone or an iPad, any kind of device, you'll see that there are questions and handouts, links down towards the bottom right-hand corner that you can access. For anyone on a computer, there is a toolbar on the right-hand side that you can, access handouts or ask any questions. A lot of people submitted questions ahead of time, most of which we believe will be answered within the presentation, but please also feel free to ask questions as we go along here today, and we'll do our best to answer those either during the presentation or in our Q&A towards the end. If there are any questions that we don't get to, we will reach out to people individually over the next couple of business days.
Mm-hmm.
And I will turn it over to Rob and Rachael with the Affordable Care Act.
Okay, so yeah, here today we're going to talk about the ACA, which is the Affordable Care Act, also frequently referred to as Obamacare. So basically how it works is it's health insurance for people under 65. You're not eligible for Medicare yet. You don't have the option or eligible for employer group coverage. You need to pick up an individual or family plan. So prior to the Affordable Care Act, when we would sell health insurance, it was difficult. There'd be a lot of medical questions. There could be physicals involved. They could ask for, doctor's reports and things like that. Now all that's gone away. So everyone has to be accepted. There is no medical underwriting, and all your pre-existing conditions are covered immediately, which is a great thing. It is mandated, regulated by the government. So there is 2 companies in Western Pennsylvania that participate on the Affordable Care Act, and that is UPMC Health Plan and Highmark Blue Cross Blue Shield. So those are your 2 options. So basically the government goes to these insurance companies and tells them that what they have to cover. And there is 10 minimum essential health benefits. So they do cover everything as far as prescriptions, hospitalizations, outpatient surgeries, all the medically necessary. For children, they also have to cover dental and vision. For adults, they do not. That can always be an add-on. So all your pre-existing conditions are covered immediately, no medical questions. Some of you asked how much do I pay, things like that. A rate is derived by a number of things. It can be your age, the zip code county where you permanently reside, whether or not you use tobacco, household, your modified adjusted gross income for your household. So if you have grandma living with you or something like that, that wouldn't count. It's how your taxes are done. And then also the number of people that are on your taxes as far as household. So that is how a rate's derived. Any questions or?
Well, we had received a question asking how much can a person withdraw from investments while still qualifying for ACA. And that is something that we at Fort Pitt can work with to kind of, per client situation, figure out how to manage their assets to keep them under a specific amount as needed.
And that's something me and Rob talked a lot about because we know that there could be a potential conversation for a Medicare meeting. There's certain things to consider whenever, so basically how it works based on the rate that you pay for your health insurance on the Affordable Care Act is it's a projection of the year that you have the insurance. But then you have to keep in mind as well, when you get on to Medicare, the income, what you pay for your Medicare to the government is based off of 2 years prior. And that's what Fort Pitt and me and Rob can assist you with. But yeah, so it's sometimes it can be looked at pay now, pay later, which one benefits you more. So there is a lot of angles to it.
Sure.
Correct.
And I think, go ahead, Rob.
I'll dig deep into that a little further on in the presentation when we talk about ways to kind of keep your income lower for one, getting a discount on your insurance, and two, when you actually go on to Medicare. But I'll say that for later on in the presentation. I promise I'll answer that though.
Yeah, it's perfect. And a lot of people ask us if they're maybe just retiring or something like that. They have COBRA. Should I do that? Is that easier? So can you speak to the Affordable Care Act versus COBRA?
Do you want me to?
Sure, go ahead.
I don't do all the talking. So yeah, so whenever, if you were to lose your employer coverage due to retirement, termination, whatever it may be, you do have the option of what's called COBRA, and it's a continuation of your employer group coverage. So it's the exact coverage that you had when you were working as an active full-time employee, but you're now paying the cost that your employer was paying plus whatever was coming out of your paycheck, if anything. Some employers will pay 100%. That's few and far between anymore, but so it's that combined total. So you're going to see a big increase in your monthly premium. So yeah, it's a high number, but the benefit there is you're still on your group plan, which typically will have lower deductibles. When I recommend someone to stay with their COBRA, even if it's a very high premium, if maybe you're at that point where you've met your deductible or you've met your maximum out of pocket, even if you're maybe paying $1,400, but you don't have to pay anything out of pocket, that might make sense. But again, it's not a one size fits all. We still have to evaluate it. But there are a lot of options as far as getting onto the Affordable Care Act, because if you are at that point of retirement, like me and Rob are kind of talking, so that seems like a lot of the people on this call, you know, you're no longer getting wages. You might not be taking Social Security. You might have a pension, a small pension, not taking from investments yet. You can get very large what's called tax credits. So what we do is when someone comes to us, they would show us the option of what their COBRA plan looks like, and then we would enter in all the information into what's called Penny, which is the state-ran program for health insurance for the ACA and PA, and see, okay, based on all your demographics, what makes more sense, COBRA or, you know, the Affordable Care Act, Highmark or UPMC.
We saw a lot of this situations too, past 3 years when COVID was going on. A lot of people were getting laid off just because, or some people were just taking an early retirement, and we were getting a lot of calls as, what should I do? Should I take the COBRA? Should I go with you guys on the ACA? And what we do is, our job is to benefit, benefit you guys. So if the COBRA was a better option, I'm going to straight up tell you, I would stick with the COBRA. And sometimes I would have a client that maybe his wife was getting treatment. She was battling a chronic illness, and they didn't want any interruption in the coverage. Something like a situation like that, I would recommend staying with the COBRA. One, she's not gonna have any interruptions. Two, they're already paying towards the deductible and max amount of pocket, like Rachel said. But other times, COBRAs, I've seen situations where a husband and wife come in, their COBRA coverage is $1,500 a month, and we can get them a plan for $200 a month. And every situation, it's not a one size fits, like cookie cutter, one size fits all. But it's something that you tell us what your COBRA's offering you, we can get back to you in the day. I get text messages all the time. Hey, work says COBRA is this, my deductible is this. I'll get back to you within the end of the day that day, telling you whether I can help you or not.
And that's great to have that resource that you can look at both options and really give them the best, because sometimes what we see is people just go with the path of least resistance, which is COBRA, and sometimes that's good and sometimes it's not. So
correct.
Good.
Yeah. So I mean, in the annual enrollment period, it runs from November 15th to January 15th. So that's the time when everybody can look at it. And that's when we always tell people to, just if it made sense for you to take one plan this year, it doesn't necessarily mean the following year it's still the right fit for you, because the formulary list of medications can change, the networks of doctors can change, the price can significantly increase. And we also want to update that projection of your income. So we always want to, you know, stay in touch every year and make sure you still have the best fit for you.
And this was a good question that we received ahead of time as well. Can spouses be on different plans? Let's say, assume both spouses are not covered through their work plan.
Yes, they can. There's no discount of having multiple people on a plan. So if the cost of a 42-year-old is $200 for a male and, you know, whatever it is for a female, there's no 10% or no family discount, anything like that when you're on the Affordable Care Act. So, you know, I'll have sometimes situations where people, you know, the husband might be sick and the wife is healthy, or the husband needs Allegheny General and the wife needs UPMC. Yes, you can absolutely. Now, after you have a third and fourth person on a plan, now you're starting to get into sharing deductibles and max amount of pockets. But as far as premium, there is no benefit having multiple people on a plan.
And just to piggyback off what Rachel said, a lot of times we'll get, like if a husband and wife have children, a lot of times the husband and wife will get a plan, but the children will qualify for CHIP, which is child health care through the state of Pennsylvania. And a lot of times they don't even have to pay for the CHIP based off their income. And it's really top-notch insurance as far as copays and deductibles. So a lot of times we'll have, you know, husband and wife on a UPMC gold plan, but then the 3 dependents will be on CHIP. So not always, but like I said, it's always case-by-case basis.
Perfect. Now, I know a lot of folks that are on this are Western Pennsylvania, and other folks are spread across the state, but we do have some folks that either retire down in Florida or other states there. So those are occasionally, depending on the circumstances, folks that can still help out, or you can point them in the right direction as well. Is that correct?
Yeah, so we are licensed in the state of Florida, as well as obviously PA and West Virginia, Ohio, South Carolina, and California. So yeah, we can help out all. Those are the states right now that we're in. Excellent,
excellent. So can you talk a little bit about UPMC and Highmark, at least for the folks that are the Western PA, you know, how that fight's going, I suppose.
Yeah, so basically the 2 main choices are UPMC and Highmark. Within their plans, I always tell people that, you know, first retiring and looking for health coverage, think of the plans like Olympic medals, because that's how they label them: gold, silver, bronze. Obviously, the gold plans are going to be much richer in benefit, but they're also going to be more expensive. And in addition to that, they have networks built into the plans themselves. So if you're someone that, you know, their doctors are all UPMC, I would probably go with one of their EPO or HMO plans, because you're not going to need to go access Allegheny Health Network anytime. But I've had people that say, Rob, all my doctors are Allegheny Health Network, but I have an orthopedic surgeon that operates only out of UPMC. Well, then it's probably best that you get a PPO plan so you can access both of them. Now, Highmark has a plan that has UPMC considered in network, so you can use them all. It's real hard to go outside of network, at least in the state of Pennsylvania, with that particular plan. Now, that plan, it's cost a pretty penny. I mean, it's the highest priced plan, but then you don't have any issues as far as, you know, is my doctor going to take this? What if I go over here and I want to rehab over there? No, but you're going to pay for it, is what I'm getting at.
Yes, I mean, there is options, definitely. Of course, there is a division. We all are very aware of that. Yeah, if you go with UPMC, obviously all your UPMC doctors and hospitals are in network. Highmark owns all the Allegheny General, West Penn. Those are going to be your Forbes, Canonsburg,
Wexford.
Yeah, Wexford, the Health Pavilion. All the community hospitals take, you know, both sides. So Butler Memorial, the Heritage Valleys, Washington, you know, that's fine. But you kind of do have to pick a side, unfortunately. Now, when you get onto Medicare, that's not the case. We do have, you know, what's called a Medicare supplement, where you can doctor anyone that accepts Medicare, which is a federal program, and basically 98 point something % of the country accepts that. So, but for the time being, if you're at that 62-year-old age, living in Western Pennsylvania, you kind of have to pick a side, unfortunately. But I would say you don't have to say goodbye to those doctors forever. Once you get onto Medicare, we can help you out as far as increasing that network. But for people under 65 on the ACA, there is a division for sure.
And then
Unfortunately.
just to add to that, once you turn 65 or go on to Medicare, there's a lot more choices, and it's not as, the networking and doctors aren't as strict. I mean, you have a lot more players. You have Aetna, you have UPMC, you have Highmark, you have Allwell, you have Humana, you have Cigna. So their choices are abundant as far as the Medicare side goes. So
it's a breath of fresh air.
It's my dad always said there's nothing good about getting old except for Social Security and Medicare. And I'm kind of finding that out. It's correct.
Yeah. What about when folks travel? Maybe if you're retiring, you want to travel a lot more. So what if you're at the beach or in the mountains of Colorado?
So no matter what plan you pick and no matter what network you pick, as long as it's a medical emergency, it's going to be covered. So you're skiing out in Colorado, you fell down, you break your leg. They're not going to say, oh, you have UPMC insurance, get in the ambulance, we're going to drive you 8 states back to Pittsburgh. No, they're going to take you to the nearest ER, and it's going to be covered like it was, like the accident happened here in Pittsburgh. Now, if you're on vacation and let's say you have a cold and you just wanted a Z-Pack or something like that, they would ask you just go to the nearest urgent care and pay the copay. So any true emergencies are covered, no matter what state you're in.
Anywhere in the world.
Yeah, anywhere in the world, really. But if it's something where it's not a true emergency, you like I gave a cold or a sinus infection, you need a Z-Pack, something like that, go to the nearest urgent care.
Okay.
And a lot of times people too, I'll say you can even call your doctor at home and ask them to fill something for you as well, if it's something like that. But no, I mean, if you were traveling, like Rob said, and you needed to see a chiropractor or something like that, no, that wouldn't be covered out of network.
We did have a question just come in saying, what's the difference between signing up for health insurance directly through UPMC or Highmark versus going through the Affordable Care Act?
So basically, the terminology has changed since Pennsylvania became a state-ran program, but it used to be considered on and off the exchange. So basically, if you're someone who's not going to qualify based on income for any tax credits or cost sharing, which means a reduction off of your premium or your deductibles and copays, you can just go directly to the insurance company and do the application and everything through their website. If you do qualify based on income for those benefits, you would want to go through Penny. Typically each year, there's usually like 2 or 3 plans that are only available with what's considered off the exchange, going directly to the insurance company. So you definitely, because a lot of times I'll still say, well, you can still go through a Penny even if you don't get any assistance because of your income, but there usually is 2 or 3 plans that you can only view and see if you go directly to the carrier. But regardless if you do it through Penny, get a tax credit cost sharing, or you go directly to the insurance company, you still have a UPMC or a Highmark card.
Right, and it's the same benefits as far as, you went directly through UPMC and you bought their gold plan.
Mm-hmm.
If you went online through Penny, bought their gold plan, UPMC gold plan, the same benefits, they're not going to change. The only thing that might change online is if the premium that you're paying, and that's if you qualify, and we would only know that based off your income and things like Rachel said at the beginning, your household income, household size, and things of that nature.
You had an example. Do you want to do one of your examples?
Yeah, so here's a perfect example. I had well, there's another example on this slide, but I just did one not too long ago. Husband and wife, they had quite a bit of assets, for lack of a better word, millionaires, and they had enough savings in their savings and checking account. They were 63, and they obviously needed to bridge something to bridge them over until they got to Medicare. We were able to go on to Penny, and because they weren't showing any income, it shows, the question is expected income for 2023. We put 0. And what that did is it makes them apply for Medicaid. Now, I know one of the questions that comes up is why do they make you apply for Medicaid when you know yourself you're not going to qualify for it because you have all this money based in either in 401ks, IRAs, CDs, whatever. That's their way of making sure the funds that are allotted to are going to the right people. So the state wants people that are truly low income and qualifying for Medicaid to be funded by Medicaid, which is a state-run program. They want to make sure people that aren't showing any income but have a lot of assets be funded by the federal government, which is the ACA. So that's kind of their way of filtering out who goes where. If you're gonna, if you're truly not showing, don't have any assets, very little income, you belong on Medicaid, which is great insurance. You're not going to pay for anything. Basically, everything's free. But whereas someone like my example that I gave,
wealthy person.
Yeah, we didn't show any income, but they have a lot of assets. They still got a huge discount. I believe they're paying like $22 a month, even though they have all this money in reserve. As long as they're not pulling out crazy amounts of money, they're going to keep that premium level for the rest of the year.
Because the Affordable Care Act, the government's looking at your modified adjusted gross income. So yeah, if they, like Rob said, if they're fine and taking very little, if nothing, then yeah, it's basically paying nothing. Whereas the state.
And that's a pretty extreme example.
But it happens. Yeah.
It definitely happens. I've done thousands of these, and people say, well, what can I do? What's the easiest way to save money on my health and premium? I said, start saving your money. And I kind of say that as a joke, but there's people that actually do that. Like they move money into their savings and checking accounts, and they just live off of it for a year or two. And then they start, once they get onto Medicare, then they can start pulling out their funds just to keep their monthly premium low.
And that's great that you all can do that as well. And that's where our planning comes in to kind of help with that, because we can look at how much is in a regular investment account. Hypothetically, should you take Social Security early or delay it? Because not only will you get an increase, but if you're potentially getting a discount through Penny or the other programs there, we want to make sure that we're showing as little income tax if it's going to help with the Medicare premiums and the premiums prior to age 65. So that's great too. That's great to see there.
Yeah, I think that there's a lot of experts, and when people you need Fort Pitt, your financial advisor, health insurance, even accountant. Like there's so many aspects to it where we all kind of can assist for sure. But accountants are big too.
People like Skylar and Emily, I do phone calls with some of my friends that are financial advisors. They'll call me and they'll say, Rob, what's the magic number? What they mean by that is, what's the amount of income? They'll say, I have a husband and wife. The wife's 57, the husband's 62. How much income can they take out before their health insurance premium goes over X? I go on my computer, we're on a three-way call with me, people like yourself and the client. We kind of figure out a, lack for a better word, battle plan going into just to keep their premiums low. And then once they get off the phone with me, they go back to people like yourselves, and they say, okay, we can access funds from here. Maybe it's a Roth IRA that you don't have to show on your taxes. Maybe it's a checking account, something like that. But there's definitely ways around the plan for health insurance until you get to Medicare.
Sure. And one question that we received earlier, prior to age 65 in Western Pennsylvania, do you have the option of doing something like United Healthcare or Aetna, or are you stuck with what you already talked about? And once you're 65, more options kind of open up.
There are options so the only plans that we represent are plans that are approved by the government that have those, no pre-existing conditions, no medical questions, no maximum lifetime maximums. It's approved by the government. They have those 10 essential health benefits. There can be insurance companies that are out there that are not approved by the government, and they're not true insurance policies. United Healthcare does have some short-term policies. Basically what they do is they can ask medical questions. They might only cover, up to a certain dollar amount in a lifetime. They might not cover certain things, might not cover prescriptions, have pre-existing conditions might not be covered. We don't sell or represent those. I don't think that I think there's way too much fine print. Yes, they're out there. I would highly discourage it, excuse me. But if you're going to take one, it's very much catastrophic coverage, and make sure you definitely read the fine print.
Okay, that's good to know.
Yeah.
I know a lot of people.
Yeah, just the 2 companies. Sorry.
No, that's great. A lot of people asked about, hey, what are some costs? What does that look like? So, I know it's, as we've talked about, it's case by case based on your income and other factors, which I think there's a slide on. But, can you walk through this slide and what this means for folks?
So this is just a basic example of, I believe this is one of the Highmark plans. I believe it's a gold plan. What you can kind of expect as far as what's my deductible going to be, what's my maximum out of pocket, PCP, copays. I just wanted to give them an idea, because people, a lot of the time they're like, man, I'm not, my work plan, stinks. I have a $3,000 deductible, and for my family it's $6,000, and I'm paying $1,200 to cover me, my wife, and my son. And I just sold one of these last week, and they were paying like $500 versus $1,400. So a lot of the times we can help a lot of people. It just, when people are given the option of continuing their work coverage either through COBRA, I always say, bring me the fine print so we can compare apples to apples. And when Rachel was training me, she always says you have to do what's best for the client. You're not going to get them all, but once you put them side by side, I mean, let the client decide. A lot of times their work plan might be cheaper, but ours doesn't have a deductible, or vice versa. So it's all, and these are so, we do so many of these. Like I said, I'd get back with you within a day. If you email me, text me, say, hey Rob, this is what work's offering. Can you do me one better? And I'll get back to you, say yay or nay. I'm going to be straight up with you.
And I think that's what a lot of people ask me. I get this question almost on a daily basis. You don't have to take your employer's coverage. So I mean, just because they offer it to you, it's not required. You can always, it always makes sense, for us to say, and even if somebody doesn't have like their summary benefits that lists, as you see here, we can very easily call like the 800 number, the member service number in the back of your card, and ask them pretty much like these 5-6 things to get a comparison. Sometimes the group coverage is better, sometimes it's not, but you do have options. So whether it be group coverage, COBRA, or you need the ACA, we can kind of just do what's best.
And just to add one more thing, a lot of times some of the employer plans are expensive. And one of the questions on the ACA is this person offered employer coverage? I hit yes, and it'll say, what does it meet the minimum essential benefits that Rachel was talking about? I hit yes, and it asks for the monthly premium. I put the premium in, the ACA system will come back, or Penny, and they'll say, that's too expensive. They qualify for discounted plan through either Highmark or UPMC.
Yeah, that's a good point. That may be a better way too for people who want like a rate. Obviously, you can call us and we can get it. You can go on to Penny, But basically, the government says that the cost of your annual health insurance premium should not exceed
8.5% of your income.
Correct. So if it does exceed that, then that's when the government comes in and they give you tax credits and subsidize you to get to that point. So you could take your annual income and kind of do it that way in your head. But of course, we can help you. Yeah, Penny. So the healthcare.gov, we used to use that when the Affordable Care Act first came out in 2014. And then a few years later, Pennsylvania went to Penny. So if you went onto healthcare.gov and typed in like shop or get a quote, and you typed in your zip code in Western Pennsylvania, it wouldn't be able to find you. So Penny is what Pennsylvania uses. So same thing, same like tax credits, same rules apply, stuff like that. Basically was just something to give a lot of people jobs in Pennsylvania.
Perfect.
I think it runs a lot smoother too.
I would agree, yeah.
When it first came out.
Yeah, because they're only dealing with the 2 companies, and they're obviously local and stuff like that, versus when you would call into healthcare.gov and it's almost all the states.
So we just had another question come in here. If I worked part-time part of the year and retired mid-year with no further income for the rest of the year, When I sign up for the Affordable Care Act, how is my income calculated?
So that's an awesome, oh, sorry.
Yeah, is it the date that they sign up or?
So it goes off the year. So what I tell people is keep me in the loop. And what I mean by keep me in the loop is, let's say you started off retired, or an example, you're working and your income's X, and then you decided, hey, I've had enough of working or whatever. Let me know so I can go in and adjust your income. And what it'll do is it'll change your premium based if you're earning more or less than what we originally projected. I had someone last year, they spent a lot of time down at the Rivers Casino. They hit for $81,000 and they didn't tell me about it. Well, the government and I need to kind of know about that, because when it comes tax time, they're going to say, hey, you only told us you were going to make 60,000. You made 140,000. All that help that we gave you, we want it back. So they kept their tax return. So that it all comes out in the wash. You're not going to be able to, I don't know, play the game or whatever, if that's what you want to call it.
Yeah.
The best thing to do is keep
on calendar year then.
Yes.
So if someone were to call me in June and say, hey, I need health insurance. I just lost my job, or I want to retire. They have a special election because the plan is terminating. And I would, Rob or myself or whomever were to ask, what is the projection of your income? Let's say it was this June of 2023. What is the projection of your modified adjusted gross income for 2023? So, and that's how it would be factored.
So in November, in a couple months when it starts, we're going to ask the client, what do you think that your household's going to make in 2024? I mean,
it's hard to do.
Yeah, we understand that. That's why we say keep us in the loop. Say, if your wife picks up a job, if your mother-in-law passed away and you sold her house and you inherited, we just need to know these things. That way you don't get surprised at the end.
So when people always say, I don't know how to make a projection, I'm self-employed, or I don't know if I'm going to draw from this investment or that, what's best? Well, it comes down to how would you prefer to pay, and just keep that in mind. Yeah, if we project on the higher side, and then at the end of the year you might get money back, and vice versa. It goes like this. So how would you prefer to pay? But yes, making mid-year adjustments, you don't have to, but then at the end of the year, either you might get a big tax return or you might owe the government a lot back. It's all even.
And one thing I do that my clients love, I tell them when I meet with them, oftentimes I go to the house, I said, if you're going to live off of 60,000, this is what you're going to pay for insurance. If you live off of 65, this is what you're going to pay for insurance. 70, 75, 80, 85, and I go all the way up. And obviously they can see the premium going up, so they can kind of get a gauge in the back of their head. Yeah, I could pull $8,000 off and fix my roof, or yeah, I can pull out $5,000 and take my kids to Disney World, or whatever the case may be. Kind of gives them a ballpark as what they can kind of expect as far as monthly premiums.
Absolutely. And it seems like that's the biggest factor for a discount. If you qualify for a discount, there's some other things as well, but it's mainly what you make, right?
Correct.
Age and income, for sure.
Yep. And then things that are included in that would include things like interest on bonds or CDs and dividends from stocks. So it's not just what you made from W-2, it's all those tax forms that you get.
Any taxable income.
Yep.
So rent, gambling that I just gave, selling a house, selling a car, anything that you're going to pay tax on, it needs to be reported.
Yep, absolutely. So this is a good part where we, Emily already kind of talked about where we help out, but strategies for keeping healthcare costs lower. Roth IRAs, Roth 401ks, those are monies that come out and they're not taxable and they don't count towards the income level when you're filing for the ACA or Medicare down the road. Is that correct?
So I just want to touch on one thing. On the example at the bottom, withdraw money early from an IRA. So this is a good strategy. I just want to make people aware of one thing. Once there's a 2-year look back period, once you turn 65 or go on to Medicare, they base off your Medicare Part B premiums on what you made while you're 63. So what happens is people are 63, getting ready to retire. They take out a bunch of money from, let's say, a 401k, and they're showing that in the year that they were 63, they were making $250,000. Let's just use that number. Their Part B premium, when they turn 65, is going to come back and be a little higher. But there's a way around that. If they are fully retired, there's a form that I have. Rachel knows about it. I know about it. And basically, it's a Medicare income related monthly adjustment amount. Basically, it's a form that tells the government, hey, I'm not making that kind of money anymore that I was 2 years ago. And it's a valid reason. And what they'll do is they'll ask for what you made the following year after the $250,000. They'll say, oh yeah, he pulled that out when he was 63, but when he was 64 last year, you know, he was only making 100,000 or whatever it may be. A married couple can, just to give you a ballpark, can make up to $194,000 combined income before their Part B starts going up. I use 250 as an example because once you go over the 194, it starts going up. So once, for people that are on Medicare right now, whether you're 90 or 65, they're paying monthly out of their Part B $164.90. All those people that are making $194,000 or below.
As a married couple.
As a married couple. Single people can make up to $97,000. So basically, my point here is, don't panic once you first go and apply for Medicare and you say, oh, my Medicare Part B premium is going to be $230.80. That's because they're looking back 2 years what you made when you were 63. There's a way to rectify that through filling out this form. But
Yeah, and it's a form from the government that they have, and it's basically just something that they don't publicize. But yeah, it's just kind of you saying, yeah, I did make that much money 2 years ago, but now I'm not. And yeah, and they do look at it, and then yeah, they will allow you to go back to, you know, paying that base premium or whichever tier you're in that year, because it can be hard for people because
right.
They're looking at, why didn't make that? I made that 2 years ago.
Right.
So they kind of understand that now, I feel, but it's the last taxes that they can go off of. So that's why they do it. So this form is something that the government has now supplied to beneficiaries.
And it's technically a change event. And the reason would be work stoppage or reduction. It says you or your spouse stop working or reduce the hours that you work. So that would include this form, and we send it in. They look at it. They ask you for a couple items. Come back. Yep, he's telling the truth. He's not trying to pull a fast one. Lower his Part B premium to $164.90 instead of the $230.80 a month.
Yeah, I mean, Medicare, and we don't want to get too much into it, but it can be very complicated. So it is definitely something, there's so many penalties involved with it, so many enrollment periods and things like that. So it's definitely, you get so much stuff in the mail. If you're 62, you probably already are starting to get it. It can be very overwhelming. There's a lot of new regulations coming out to protect Medicare beneficiaries because, yeah, you get cold calls and things like that. And unfortunately, you know, there's been a lot of people of that age that have been, you know, sold something over the phone that they didn't even realize that they were purchasing, which is a shame. So the government is out there to protect you, but it's also very complicated. And that's definitely one of our expertise is Medicare as well.
That's what this will bridge into the Medicare presentation. We'll talk about that further on down the road. We can talk about that all day, but
yeah.
So a lot of our clients have HSAs, and where do you see that come into play here prior to 65?
So
It's a great thing to do.
yeah, I have one, I have one through my wife's work. She works with BNY Mellon. Obviously, when they retire, they get to take that money with them. That money follows with them. That's your money. So if you want to put it in something, stocks or bonds through Fort Pitt, and it can earn interest for you. You can use it to take out to pay your co-pays once you get onto Medicare. You just can't contribute anymore once you finally do hit 65 or retire. Now, the one caveat I want to say about the HSA is once you're 65 years old, you're allowed to use that money for non-medical expenses. It'll just be taxed like a IRA would be considered taxable. But if you want to use that money to, you know, buy a car or whatever, or part of a car or something, or do a car payment with, you're allowed to do that. So there's definitely advantages to using an HSA. Obviously, you'd have to use a high deductible plan, and the ACA offers them. UPMC, just off the top of my head, has an awesome HSA plan, and even the family max amount of pocket is only $7,000.
And that could be a family of 5. So,
Right. You have 5 people eating
You
at
can't
that.
beat that, yeah.
This day and age, you're not going to beat something like that.
So the HSAs are nice. Yeah, I mean, even if you're not contributing to it, the plans, you do pay 100% of the cost for all medical bills, including prescriptions, when you're on an HSA, to the deductible, and then typically a percentage called a co-insurance to that max amount of pocket. But they are much lower. The deductibles and max amount of pockets, like Rob said. But the downside some people don't like is, instead of going to the doctors and handing your primary care doctor a $20 copay, you could be getting a bill 2 weeks later in the mail for $112 because you're
Right.
paying 100% of the cost for everything and to those amounts, but also contributing to the HSA. You don't have to contribute, but it does make sense. And every year the government does regulate how much you can put in there. I have a lot of people that just enter in at the beginning of the year that exact amount, that maximum. If you're self-employed, there's a lot of benefits in doing so as far as taxes. But yeah, that's your money. You can use it.
If you're someone that's fairly healthy, you're going to save a lot of money doing an HSA because it's going to keep your monthly premium lower than someone that has a no deductible plan and they only pay $5 when they go see their PCP, or they don't pay anything when they see their PCP. Someone like that should probably, has a lot of different issues, should probably be on a plan like that. Pay a little bit, pay more a month and not have such a high deductible. But HSAs are great for people that say, I can't remember the last time I was at the doctor's, something like that.
Now for HSAs as well. Sorry, Rachel and Rob. Let's say that somebody accumulated and then now they're retired. So the great thing is, like you said, you put money in, it's tax deductible. It grows, hopefully, if you invest those monies, and if it's used for healthcare costs, it's tax-free, distribution. So it's really the only account that you get a tax break in and a tax break out if you use it properly. Is there anything that you can't use it for? Can you use it for premiums on healthcare prior to age 65 or Medicare premiums?
No.
Okay. You're not.
Yeah. So that's an important question. A lot of people ask us is, can you use it for that? No, but you can use it for when you see the doctor if you're retired, just not.
You can even use it for if you were going down to McGee and it was $20 to park, you could use it for that parking lot, but no, not premium.
Correct.
Well, and from our perspective, we assist clients a lot in the investment aspect of an HSA and making sure that, the money is growing and working for individuals while they are still putting money in and not really using it while they're still in good health, in order for it to grow so they can utilize it later in life.
Yep.
Absolutely.
Great.
So we've talked a little bit about the income, and when you are settling up with the IRS, if your income is too high. A question that we had on this is there a penalty if you say you're going to make $50,000 and you make $100,000? Do you get hit with an additional penalty, or is it just what you should have been paying all along anyway?
It's exactly what you said. It's just what you should have been paying. So like the original example that I gave about the person going down to the casino and hitting for $81,000 and not telling me. Then they called me and they said, well, I didn't get a tax return this year. I said, did you sell anything? Did you pick up any extra work? I said, no, the only thing I could think of is I hit that $81,000. I was like, well, they kind of need to know about that. It's not tax free.
But no penalty.
But no penalty. On the flip side, let's say you say I'm going to make $100,000 and you only end up making $70,000. Government come tax time is going to say, hey, we should have been giving you way more help throughout the year. Here's a bigger tax return. So it's all going to come out equally. But that's why I always said, always communicate to me or Rachel if you decide to work with us, and you'll be fine. You won't have any problems.
Yeah, and I think you can make mid-year adjustments. So yeah, if that person would have contacted Rob, yeah, they still would have paid that lower premium the first couple months in the year that they would end up at the end of the year in taxes owing money back on, but it could immediately change your premium going forward. So at least you don't have so many months that you're owing back at the end of the year when it comes tax time. So, but it all evens out, no penalty.
Good. I think you already touched on this, the open enrollment, as well as if there's a life-changing event, like if you lose your job in June, you don't have to wait until November to enroll.
Correct. You have 60, when there's any life-changing event, you do have 60 days. So, and even getting back to COBRA, sometimes people, you have from the time that you stop your employer plan for whatever reason, you do have the option of COBRA, and you have to pay that within 60 days if you want it. The reason they give you 60 days is it takes a lot of times, some time for that paperwork to go through, because your employer has to notify the insurance company, and the insurance company sends you a letter now with the full premium. So they do give you 60 days. So if you didn't pay that COBRA for 60 days and heaven forbid something happened, you could always pay it and it would be backdated. You would have to pay the 2 months. But that's kind of why it goes hand in hand, that the ACA, the Affordable Care Act, gives you 60 days for special elections to enroll as well, if that makes sense.
Correct.
Absolutely. So here's any important things to remember
Yes.
on some.
So this first point with the ACA plans, it's not like this with Medicare. Everything on the ACA plans goes towards your max out of pocket. So right now, currently on Medicare, I know Congress is working something out for 2025 as far as the prescription, max out of pocket, and the medical out of pocket. But the great thing with ACAs, let's say you're a person that never goes to the doctor, but you're on insulin because you're a diabetic. That all goes towards the same max amount of pocket. It all filters into one pot. So it's a lot easier, which is good, to hit the max amount of pocket.
And for budgeting too.
Yeah, if you're budgeting, you say, what's the worst case scenario that I, let's say I have the worst year of, health-wise of my life. You look at the max amount of pocket. Okay. And then you can kind of game plan as far as, where you need to keep your money as far as preparing for a rainy day. And once you hit the MOOP, max amount of pocket, that's the abbreviation. There's a lot of acronyms in insurance, if you haven't figured that out already. So once you hit the MOOP, as long as you're paying your monthly premium, everything's on the house the rest of the year until January 1st, then it starts over again.
And there's no maximum that the insurance companies can pay. That's done with. So they have to pay indefinitely, but you have a max amount of pocket. And yeah, like Rob said, on the Medicare side, the prescriptions currently don't go towards it. So it is harder to tell somebody like, well, what's the most I can pay? Well, it depends. How many medications do you have? The cost of medications are crazy. There are a lot of drugs, very common drugs that people take. Eliquis, $600.
Zelienople, Rantain.
Very common drugs, yeah.
Yes.
Very expensive. So that is a nice thing with the ACA.
Good. Fantastic. So obviously folks can reach out to us if they have questions, and we can get you in touch with them, but this is your contact information, and it looks like there's no cost consultation. Tell me a little bit about how you work and how you get compensated.
So basically how we work is we basically work for the person based off their situation, and they'll pay the same price as if they went through the company direct or someone else. We get compensated from the actual health carrier. So a lot of times I go into a household, my Medicare example is a little bit better. There's so many choices with Medicare. So I go in and I don't know the prescription drugs someone's taking. But after looking up the prescription drugs and the doctor's copays, we put, the 5 companies and 5 plans side by side. And I say, Mrs. Jones, the United Health Care plan's looking pretty good. She would agree with me. United Healthcare comes back to me and Rachel and says, hey, thanks for getting them on our plan and finding them. Here's your compensation. So our clients never pay us any money, is what I'm getting at. So, and
it makes no difference to us if you go with, in Medicare, there's plans that are 0 premiums. I'm sure you've all heard of them. There's plans that are $300, whether you get a tax credit on the ACA, you go with hemorrhage PMC, it makes absolutely no difference to us. There's no bias there. We're compensated by your enrollment. So we want to do what's best for you. We send out mailers every year to our clients when the open enrollment approaches, saying, hey, it's that time of year again. Give me a call. Do you want to set up an appointment? Regardless if we spend 20 hours with you, 10 minutes with you, no, there's no cost to our services. We are compensated by the insurance companies, and how we make a living is by referrals too.
Right.
So obviously if we don't do our due diligence and take care of you and make sure that you're on the best plan every year that fits your needs, then you're not going to recommend us to people. And that's how we make a living. We satisfied the husband, and now, the wife calls us when she turns 65, your next door neighbor. our clients are very happy with us. We do
Right.
the right thing for them because it makes no difference as far as the compensation level.
And I know like a lot of people that do the same thing that we do. They don't give out their cell phone numbers. Me and Rachel do because we answer clients' calls and texts on the weekend. I mean, it's true.
Well, a lot of my clients, I have an 80-year-old client that calls me every Sunday because she doesn't know what day of the week it is, but we still chat. And yeah,
And people like that. People don't like to wait till Monday. I'm like that person, you know, if something comes up on Saturday and I don't want to wait till Monday. I want to know now. So yeah.
I think our office, yeah, we're all very passionate about what we do. It's very rewarding because it's something that you need, and there's no plan that we can't offer you. So it's basically, if you don't want to work with me, it's because my voice is like nails on a chalkboard to you, because we have everything out there on the table as far as our product portfolio, and very knowledgeable. We have to go through trainings every year this time of year, but yeah, and we really appreciate Fort Pitt getting us in front of all of you. This was a
That's
nice little
fun.
chat.
We appreciate it as well. You've given us a lot of good information. I mean, we've almost been at this for an hour, so we covered hopefully a lot of the questions that were sent in. If you have a question now, please type it in. We'll monitor that for a few minutes while we're waiting for any additional questions to come in. This is maybe a little bit of an odd one. Some of the folks that we work with, maybe they've been in this country for a long time, but they never were, never got their citizenship status. Maybe one spouse is a U.S. citizen and the other one is here and has worked here and paid their taxes for 20 years, but they're not a U.S. citizen. Or those are still people that you can help get set up through the healthcare system. Is that correct?
Absolutely. I do a lot of those down in Oakland with the Chinese restaurants down there. A couple of my clients come over on a green card or a visa or whatever. There's a spot in the application where they ask for that information. You just type it in. Yep, they verify it. You're good to go.
It's the same rules
Yeah.
apply.
Yeah.
Now, whenever you get onto Medicare, you definitely have to have paid into, either you or your spouse paid into the Social Security tax for 10 years, 40 quarters in order to qualify. If you don't, that's still okay, but you will pay additional premium.
Well,
But the ACA, there's no difference in cost.
nope.
And we're waiting for a few more questions to come in. While we do, join us next month. We will be talking all about Medicare. We'll have new folks on here to give you a different perspective. Rachel and Rob can help you with that as well. But join us if you or a spouse is of that age. And I'm guessing, Rob and Rachel, you come across this often where one spouse gets on Medicare, but the other one still needs to be on a different plan. That comes in a lot, right?
Absolutely, yeah. Most of our clients, yeah, their birthdays, of course, are different, times. So absolutely, yeah.
Good.
So you can register for our webinar on our website, www.fortpittcapital.com. Thank you to Rachel and Rob for being with us. We really appreciate your time.
And I want to do a special shout out to Miranda and Haley and Lisa for setting this up and making sure the technology works. So hopefully everything worked well on your end. We always want to make sure that to show the disclosures there, and send this to friends or colleagues that you have. You'll be getting an email later with the link. So if you have any questions, please reach out to your advisory team, reach out to one of us individually. We'll look through the questions to make sure that we covered everything, but we really appreciate your time this lunch hour. So
Thank you so much.
Thanks for having us.
It was nice talking to you guys. Thank you.